ratio is a mathematical relationship between two items expressed in a quantitative form. Ratios can be defined as relationship expressed in quantitative terms between figures which have cause and effect relationships or which are connected with each other in some manner or the other. Ratio analysis is an age-old technique of financial analysis. It is a process of determining and presenting the relationship of items and group of items in the financial statement. Now we'll move to the problem. From the following, compute the value of stock. Sales rupees 10 lakh, gross profit ratio 25%, stock turnover ratio 10 times, closing stock is more than opening stock by rupees 25,000. Let us calculate first gross profit. Gross profit equal to sales into gross profit ratio. The problem they given sales 10 lakhs, GP ratio 25%, it comes around 2,50,000. Then we move to the cost of sales. Cost of sales equal to sales minus gross profit. Sales already they given in the problem 10 lakhs. We have found out gross profit 2,50,000. So the cost of sales is 7,50,000. Then we'll move to the stock turnover ratio equal to cost of sales divided by average stock. Stock turnover ratio they given 10 times. Cost of sales we have found out 7,50,000. Then we have to find out the average stock. So just cross multiply. Average stock equal to 7,50,000 divided 10 times. It comes around rupees 75,000. So in the problem they given closing stock is rupees 25,000 more than the opening stock. Closing stock equal to average stock plus 1 by 2 of excess of closing stock over opening stock. So average stock we have found out 75,000 plus 1 by 2 of 25,000. So 75,000 plus 1 by 2, that is half of 25,000, it comes around 12,500. 75,000 plus 12,500, it comes around 87,500. Or alternatively we can go for this formula, average stock equal to opening stock plus closing stock divided by 2. If opening stock is X, 75,000 equal to opening stock X plus closing stock X plus 25,000. That is closing stock is more than the opening stock by 25,000 divided by 2. So cross multiply 75,000 into 2 minus 25,000 equal to 2x. So x equal to 1,25,000 divided by 2, it comes around 62,500. So it is the opening stock we have found out 62,500. So closing stock equal to 62,500 plus 25,000, it comes around 87,500. Then next we move to the next problem. Ascertain closing debtors from the following data. Total sales 40 lakhs, cash sales rupees 4 lakhs, debtors collection period 60 days, within bracket 360 days in a year. Closing bills receivable rupees 10,000. First we find out credit sales. Total sales minus cash sales will get credit sales. The problem they given total sales 40 lakhs, cash sales 4 lakhs. So we get the credit sales 36 lakhs. So debtors collection period equal to days in the year divided by debtors turnover ratio. Debtors collection period, the problem they given 60 days equal to days in the year, the problem they given 360 days divided by debtors turnover ratio. So debtors turnover ratio equal to 360 divided by 60 comes on 6 times. Then debtors turnover ratio equal to credit sales divided by average receivables. Debtors turnover ratio we have found 6 times equal to credit sales 36 lakhs divided by average receivables. If you cross multiply, average receivable equal to 36 lakhs divided by 6, it comes around 6 lakhs. In the absence of opening items, average receivable equal to closing receivable, that is 6 lakhs minus bills receivable 10,000, closing debtors it is 5 lakh 90,000. Next problem, find out creditors from the following details. Purchase 14 lakhs, cash purchase rupees 2 lakhs, bills payable rupees 50,000, creditors turnover 2 months. So we'll find out first credit purchase. Credit purchase equal to total purchase minus cash purchase. Total purchase, the problem they given 14 lakhs, cash purchase 2 lakhs. So if we deduct, we'll get 12 lakhs. Then creditors turnover in month equal to month in the year divided by creditors turnover ratio. Creditors turnover ratio in month, they given in the problem 2 months equal to month in the year 12 divided by creditors turnover ratio. So creditors turnover ratio equal to 12 month divided by 2 times, it comes around 6. So creditors turnover ratio is 6. Creditors turnover ratio equal to credit purchase divided by average accounts payable. Creditors turnover ratio we have found 6 times equal to credit purchase 12 lakhs divided by average account payable. So average account payable equal to 12 lakhs divided by 6, it comes on rupees 2 lakhs. Already they given in the problem bills payable 50,000. So creditors will be 2 lakh 50,000, that is 2 lakh minus 50,000, it comes around 1 lakh 50,000. We have to find out, that is it is a note there, average account payable equal to bills payable plus creditors. Then next we move to the find out fixed asset and gross profit from the following information. In the problem they given sales 10 lakhs, gross profit ratio 25%, fixed asset turnover ratio on cost of sales 5 times. We know the gross profit equal to sales into gross profit ratio. Sales equal to 10 lakhs into GP ratio 25%. So it comes around 2 lakh 50,000. Cost of sales, sales minus gross profit. Sales, they given in the problem 10 lakhs. We have found gross profit 2 lakh 50,000. So 10 lakhs minus 2 lakh 50,000, it is 7 lakh 50,000. Then fixed asset turnover ratio equal to cost of sales divided by fixed asset. Fixed asset turnover, the problem they given 5 times equal to cost of sales 7 lakh 50,000 divided by fixed asset. We just go for the cross multiply. Fixed asset equal to 7 lakh 50,000 divided by 5 equal to rupees 1 lakh 50,000.